Today we'll talk about the trading strategy because I continue to receive requests on Telegram. Some people are writing comments on that. So although there is no ideal strategy which will help you to make money every time and in every market, but there are some guidelines which you can think of which are actually useful, and you can make money if you'll try to eliminate your emotions and strictly follow the rules of the strategy. So first of all, I must say that of course everything which I say is my personal opinion, not a financial advice. So if you would decide to use this strategy in your trading, then you would have to take the risk. Second thing is that of course it will not give you like 100% profitable trades, but instead it gives you some average profit. Like you may have 6 trades from 10 which will be profitable and 4 trades will not play out. So on average, with using stops, you will be in a profit. So first of all, you need to define whether you are in a bear trend or a bull trend, like in a long term. So for example, here it was a bull market, here it was the bear market, now we are in a bull market again. How would you define that? So you are looking at your moving averages. Here I use 50, 100 and 200 moving averages, but changing those to different numbers will just give you a definition of a longer bear or bull market. So for this particular case, you would see that the price is above all 3 moving averages here, and also we recently have 2 golden crosses when we had 50 and 100 days moving averages intersecting the 200 days moving average. So it means that, okay, we are to some extent in a bull market. So you need to trade it accordingly. But here we don't have that much of the history for the bull market. So I would suggest let's switch to the historically proven area, which is 2017, and you actually would see that even in 2016 there are also like areas when the price is above moving averages, and we had golden crosses before. So technically everywhere here we can find the rising trend which you can trade accordingly. So on the rising trend we are looking for the entries to go long. On the bearish trend, we are looking for the entries to go short. Those would be our starting points. So what do? You're looking at the chart and you are waiting for the place in the chart when the price will hit the area which previously served as a resistance level. For example, right here. So you see the price had a pullback from this line and then it broke it and traded in this channel. Actually, we have the price touching it here and touching it here. So what do? You look at those 2 points. Those are your potential entries. So then we have our indicators. First is stochastic oscillator. The settings for the stochastic oscillators I use for this particular case 733, but you can use defaults. I think it will be like 1433. So now you're looking at this point. And in fact, when you have the support at this line, the candle which you look at is the second candle, because only next day you would know that this support level actually held. By the way, I would suggest to trade a daily time frame. You can go as short as maybe 4 hours, maybe even 1 hour, but I would say the longer time frame you use, the more reliable it is. So definitely don't trade it on a 1 minute time frame. Okay, so you look at this next candle and you look at the stochastic oscillator and you want to see the intersection when the blue line, which is like a default setting here, blue line intersects the red line. This intersection, and if you don't know about stochastic and other indicators, you can refer to my previous videos or just Google it, but in principle you don't need to know the fundamental of that, you just need to know how to use it. Okay, so we have this intersection which shows us that the trend is bullish, that we have the reversal from the temporarily declining price to temporarily rising price. Okay, we have this intersection, but it happened just after this candle. So in principle, since we don't have this intersection here, this entry point is not valid. So let's look at this one. Here on the next candle, we actually do have this intersection happened the day before. This is great. So now we are looking at this green candle, and stochastic oscillator confirmed us that this entry is potentially a good entry to go long. So the third thing which we are doing is we're looking at the CCI or commodity channel index, and you need to check whether the value of CCI, the settings here are 7 for the length and close for the source. Again, you can set a default. I think default is 20 for the length. So what you're looking here is that CCI is above minus 50 level. This is for entering the long position. If you are trading in a bear market and you're entering a short position, then the value for CCI should be below 50. So again, bull market above minus 50, bear market below 50. So you look at this candle, you look at the value of CCI after checking the stochastic oscillator. So CCI here is something like 16 or something like that. So it's well above 50. It's a good entry. So you buy here and you're waiting for the profit. So again, the moving averages help you to define the trend in order to decide whether you are entering long or short. Support resistance helps you to identify the potential points to enter the trade. Stochastic oscillator helps you to see whether this point was actually the reversal from the one trend to another. And CCI identifies whether the reversal is strong enough, whether we are going with the trend or we may actually try to catch a falling knife. Okay, of course, as I said, not all the trades will be profitable, so you need to set your stop loss. Well, technically you may put your stop loss somewhere around here, just very close to the support level, and if the price will go lower, then the only one thing which happen is that you will lose a very little portion of your money which you put in this trade. So let's assume that it didn't happen and the price actually went up. As soon as it did went up, you start to move your stop order higher, closer to your entry point. So in the case that the price will go lower, you will not be in a loss completely. So as soon as you do that, you are looking to the level which was previously a resistance, for example here, and then you set your first take profit order around here. And this is a trade-off between your greed and cautiousness. So you may sell like 25%, you may sell 50% or all your position. But as soon as you have your stop loss set to the area where you bought initially, in principle you can hold your position until the point when you will see the opposite signal for the short, so like through the whole bull market until it will turn to be bearish. But a wise trader will probably fix the profits on the way up. So I would suggest not to chase all the profits which you can get, but constantly closing your position on the way up, because no matter how much you will earn, profit is profit. So let's look at another example. The previous level of resistance which we just looked right now, here, we finally touched it once again. Here is our support. So you look at this candle and you don't trade it yet. Well, you technically can, but I would suggest to wait one day. Of course, you will miss some part of this rise, or at least may miss it, but you will have a confirmation. In any case, even here, you would see the buy signal on stochastic oscillator. This intersection exists. And now you return to CCI, and this day is very close to minus 50. Next day is a little bit above minus 50. So again, next day is more reliable. You have then this trade at this day. You set a stop order and you're waiting for the profit on this position as well. So what you do again, you see the next resistance. You may sell somewhere around here, at least part of your position, and then continue to fix your profits on the way up. In fact, you may look at the other points which are not exactly fulfilling those requirements. For example, this one, you see, it has a support on the level of resistance which was before. And then you may look at the next candle, you would see that actually technically there is an intersection, but this intersection happened just the end of this day when we had the rise of this candle almost to the top. So it's really risky to take it at the beginning because you still didn't have the intersection on stochastic at the beginning of the next candle. Well, and so on and so forth. So you may find other examples like that, and you can switch to 4 hours chart. So you will have like more trades available, which would be a little bit more risky, but still. And by the way, if you look at the 4-hour chart with the same condition as we just looked at, you would see that on the 4 hours chart, this stochastic signal is already there, and CCI also is really positive. So in principle, on 4 hours chart, you may take this trade. And this illustrates what is the difference between the longer and shorter time frame in terms of higher and lower risk. So adopting this strategy will not give you like covering all the price action which is out there. So you may in principle just hold some around here and you will be good until you will sell at the very top. But while people are saying that it's actually better to just buy at the very bottom and sell at the very top, or if it's possible to sell at the very top, at least holding through the whole market in 2017 was more profitable than trying to catch those swings in the price. Technically this is true, however, this is the difference in fact between the trader and investor. Investor catching the proper trend would be maybe more profitable, especially if we are talking about not a professional trader who can probably beat the investor even on the market like this. But another difference is that while investor may have a higher profit, he or she also has a higher risk because the investment may or may not be profitable, especially in the case that investor doesn't know when the exit from the investment will be. Again, of course, investor may sell around the entry point, but because of the length of the investment, it will be not profitable effectively comparing to what a trader can do. But at the same time, comparing the situations when you buying here and selling here to the trader scenario, trader may not have that much of a profit, but because of the statistically having positive outcome from the trades, the risk profile for the trader will be more reasonable. In any case, guys, this is the strategy which I wanted to share with you. And of course, there is a whole other bunch of things except the actual trading execution, which should be included in your strategy, like managing your risks, like the allocation of your trades with respect to the size of your portfolio, and so on and so forth. But anyway, if you decided to use it, don't be greedy, because remember, greed is the worst enemy of profitability. And don't forget your stop orders. I hope it was useful. Thank you for watching.